Welcome to Central Bank Central. I'm Kathleen Hayes. Today, the Federal Reserve ended up its two-day meeting with a widely expected decision, and that was the decision to do nothing on interest rates after cutting them three times in a row in the latter part of last year. So, where is the Fed now? What's the message from Fed Chair Jay Powell? What is the Fed going to do next? Very happy to welcome back to Central Bank Central Vincent Reinhart. Vince is Chief Economist at BNY Investments. He also spent 24 years at the Federal Reserve. He held several roles, including the director of the Division of Monetary Affairs and secretary and economist of the Federal Open Market Committee. That's the Fed's policy-making body. So, Vince, it's great to have you back. And one of the reasons it's so great is you were at the Fed for a very long time, and there's something about the Fed. Once at the Fed, you're always still at the Fed in a way, right? You've been there, done that. You watch the Fed closely. So, uh, the on hold, that's what the Fed said. That's what Jay Powell said. Um, is this what you expected? And what do you think the message is here?
First of all, I measure it in dog years, so it seems even longer than that. The second, it came completely as expected. Market pricing was at no policy action. They did nothing to disabuse us of that notion, and the Fed hates surprises in the modern world. And there were no commentary in the lead up to the meeting to make you think they'd do anything. They did nothing. But I would characterize it as not the decision to hold policy rates unchanged it was the decision to wait and see. They put three-quarters of a percentage point worth of policy ease into the system starting September last year. They were buying insurance because they were worried about the slowness of employment growth. They're probably pleased with themselves for having done that. They see aggregate demand growing very briskly. That's GDP and well in excess of trend. And they're just waiting and see how costly the insurance premium is. That is how slow inflation will be to fall.
Well, the other side, of course, is the, what's the labor market going to do? They seem very closely focused on that. But listen to what you just said, because when you say that, it makes me think you're saying, well, that's what they're really watching now. That I guess they are just going to be on hold, and maybe that's the big thing they're looking for. They've got to see some progress on inflation before they can cut rates anymore. Other people have said that, but when I listen to some Fed officials, not all. There are clearly some who've already said, look, inflation's got to start falling before we do more. Is that what you're getting? Do you think that's their position? That's a key thing they're going to watch now?
Yeah, so the way I would think about it is work backwards. Suppose I told you the Fed just cut rates. What would have had to happen? The answer is one of two possibilities. One is employment faltered. They were worried about an outright decline in employment, an increase in the unemployment rate, and they went into the break the glass mode, cut rates. The other would be, well, they saw inflation fall a little bit more. They view it as durable decline, i.e., inflation trend is at a lower level, and they realigned the nominal policy rate lower so it didn't increase in real terms. What we heard from a relatively upbeat Chair Powell about the economy is they're not much worried about the first case. They see the labor market in a low hire, low fire equilibrium, but with aggregate demand growing, that's the support to the economy they need. So, why would they cut rates? The latter case. They cut rates if they see inflation fall in a way that will stick and it justifies lowering the nominal rate to make sure the real rate doesn't go up.
Hmm. Well, he Powell also noted the Fed funds rate, their key policy rate, is in the upper range of neutral. Noted that most FOMC members see the Fed funds rate eventually lower. Uh, so, is this a long run statement? Do you think it points to later this year? And it does in terms of what you just said, they're going to have to see inflation start improving before they can actually cut rates.
Oh yeah, that's why we don't think they cut rates anytime soon. And the easiest way to see that is just draw back. Basically, when they entered last year, they were on a plan. lower the nominal funds rate occasionally as a realignment to make sure the real rate doesn't rise, and then slowly pull the real rate into its neutral rate. The Trump administration interrupted that plan. Tariffs put upward pressure on inflation, and border policy slowed employment growth. By September, they were worried about the latter. They were actually more confident about the effects of tariffs on inflation. But given the slowness of employment growth, they were worried about the labor market hitting a stall speed and that there be more dramatic interactions. They wanted to avoid it. They avoided it by buying insurance. Having bought the insurance, they're back to their plan. Realign the nominal funds rate when you can justify it. And the way you justify it is inflation falling durably. In our forecast, inflation moves sideways some, then continues to fall back towards the Fed's goal, but that's later in the year. And so this is not an FOMC that was prepared to cut rates today, too early, and didn't give any indication of doing it at the next meeting. We'll get some guidance with their forecast at that meeting, but for now, it's wait and see. And what they're waiting to see is inflation falling.
Okay. Well, they've been well above target for what, nearly 5 years now. And they have continued to say, oh, of course, we want to get back to 2% inflation. But they haven't, and they did cut rates 3 times in a row when there was still some doubt about how weak the economy was. The economy has not been heading toward recession, all these different things. And now looking even a bit stronger perhaps as we go into
Yeah.
2026, right? So what kind of move down in inflation do you think they need to seek? And they say, oh, well, we got from 2.7 on the headline to 2.5. Oh, the core went from 3.1 to 2.9. What is that going to be enough? Oh, we started to fall again. Or is it going to take something where you can see substantially heading at least to 2.5 and down to 2?
So I think it's not substantial, it's the components. They want to see the sticky part of inflation, the part associated with service prices, shelter, the contractual part. They want to see that inflation rate falling. And that actually is the part that slowed up, that stalled out its descent over the last couple of months. Goods prices move around. They're going to look past that. They're going to say it's tariff effects, so they won't be paying attention to the headline. It'll be core. It'll be even core as they slice and dice it. What they need to see is durable decline in inflation, i.e., the stuff that moves slowly is moving in the right direction.
So that's one side of the equation, right? The other side is jobs, employment, and of course, the labor market's very hard to gauge right now because there were the shutdowns and those effects linger, because there were deportations and the immigration has just come to a halt. So the natural rate of what you'd expect jobs to grow every month is very, very hard to read. Um, Powell said that it was hard to tell if the upside risk to inflation was greater than the upside risk to unemployment. Uh, is he sort of then? I mean, I guess that is he still on the fence then? And is it possible that we should, if they're going to, will they stick with this, your view, what you're saying they're saying, which is, hey, you got to get inflation down if jobs weaken, if unemployment doesn't look as strong?
If the labor market softens a bit, they will respond. As they're close enough to goal, they view deviations of employment from full employment as more concerning. That's a consequence of having the dual mandate. They're worried about inflation, of course. They want inflation to get back to goal, but missing on inflation has to be weighed against missing on employment. And if they start missing materially on employment, they'll react. Federal Reserves always react. Actually, that's pretty bipartisan in response. So, yes, if employment growth falters, if we see some negative prints on net job creation and the unemployment rate rising, yeah, you'll get a response out of the Fed. What you heard from Chair Powell, who is mostly upbeat about the economy, was that looking at the disconnect now, relatively rapid, vigorous GDP growth and sluggish growth in the labor market, it's not clear which is going to win out. The lore, as he said, is that it's the labor market, but he said lore, not law, that i.e., in an environment in which you're getting above trend real GDP growth, you're generating income, uh, you're seeing pressures on some resources. They're hoping that that compensates for the softness in the labor market that's basically in that low hire, low fire equilibrium.
So how do they, how much weight do you think Powell and company are putting on the weak hiring of college grads? Oh, well, they covered programming instead of AI, et cetera, et cetera. What are they going to do? Uh, AI and the impact, productivity, you could say, well, we don't know how much really it's boosting productivity. The assumption is that it is, but it certainly does seem to be an issue there. How much weight do you think they're putting on that?
They're certainly following it. They got a big staff. They're on top of that. But the more they drill down into the employment details, the more will sound like a sectoral shock. And monetary policy isn't good at a sectoral shock. What they'll think their role is, which is appropriate, is generate enough income overall and hope the distribution works. If GDP is growing, well in excess of its trend, that probably makes the pie big enough that get distributed. And you shouldn't worry as much about the sectoral problems in employment. They can't do much about the sectoral stuff.
True. Um, in terms of a very specific number that just came out yesterday, and the Fed, I'm sure, saw it, was the Conference Board's Consumer Confidence Index. And it took a very
Mhm.
big hit. Now, and it's very much weighted towards labor market conditions and
Mhm.
expectations, et cetera. Just one number, it doesn't probably change anybody's view, but when Vince Reinhart, chief economist at BNY Investments, looked at it, what do you think? You think, maybe that's a little warning sign, or we just have to wait and see for more data on this front?
I'm in a wait and see mode too. But part of it is, the reality of the first year of the Trump administration is polarization is extreme, and it's very difficult to get a true sense of underlying sentiment because everybody's relitigating the election. You see it clearly in the surveys. Look at the Michigan survey where they split the data up by party alignment. Uh, Democrats, respondents believe the economy is in the worst recession on record. Republicans are giddy in optimism about the economy. They're relitigating the election. So sentiment readings are just tough to interpret in an environment in which pretty much everything everybody says is really saying something about the election.
Yeah. So again, to kind of come back to the same question, if the Fed has to get inflation down 5 years above target, maybe they are starting to realize that too many people are noticing that. And if you want people to believe you that you have a 2% target, you got to do something at some point. But again, I just want to make sure I understand you clearly that at the point, if inflation uh, isn't coming down yet, and maybe many Fed officials, people at the FOMC might say, we got to stick with this. We got to keep this level of interest rates, et cetera. But there are more signs of labor market weakness. Do you think then the Fed Powell's going to be, the whole team's going to be more willing to say, well, we've got this strong growth, we still got spending, so we're gonna ride this kind of murky job data and be more likely not to move as much as they might have, three rate cuts ago than they would be now when they say, no, we really have to be serious about getting inflation lower.
So I think their answer is we already did it. 75 basis point reduction in the nominal rate was the insurance for the labor market. And let's ride that out. If GDP growth is still well maintained and you got a forecast where it continues to be well maintained, which seems to be the case, they'll tolerate a weak labor market as just evidence of that's what happens in a higher low fire environment. That's what happens when net gains in the workforce are so weak given attitudes toward the border. So they will tolerate more weakness in the labor market than traditionally. If the labor market really weakens, though, they will respond.
So, financial conditions, how big of a is that how much is that another reason why the Fed would say we've got plenty of stimulus? Financial conditions are very generous, and that's maybe another reason why there's investor confidence, people all that kind of thing that I think more and more people have noticed. We've had the big stock market rally. We've seen all kinds of things that would suggest that's the case.
So first on Chair Powell's list of why growth was above trend was financial conditions, which are quite accommodative. Investors are quite receptive to taking on risk. Volatilities are low, risk spreads are low. The long-term treasury yield is lower than before the election still. So in that environment, they see accommodative financial conditions. They also have to wonder how much more support does the labor market actually get if they were just to fuel even more of that financial accommodation? And so, yes, I think they look at it, and I think right now they look at it as a reason to have a forecast where real GDP grows above trend, income gets generated, and that should paper over dislocations in the labor market.
Let's take a look at the US dollar. Certainly, a lot of people are noticing that it's gotten weaker. And Jay Powell, of course, couldn't. It was very easy for him to say, as the Fed chair, I can't talk about that.
Yeah.
That's what the US Treasury Department is in charge of. So I can't talk about the dollar. But we can only imagine. And hey, you were the head of the Division of Monetary Affairs. You were the secretary. I'm looking at the exact title again. The secretary and economist at the FOMC, Federal Market Committee. You wrote up Fed minutes. We know that the Fed does talk about this, right? In the course of a big meeting like this, they're going to talk about global conditions, forces, etc. So, what do you think the Fed might really be thinking about the dollar and what it means for the U.S. economy and U.S. bond markets, etc.? And what would you be saying if you were there?
Well, first of all, when they talk about the dollar on foreign exchange markets, they talk about it with humility because it's really hard to understand the fluctuations in the dollar. Right now, they probably view it as having two parts. One is the traditional difference between the stance of monetary policy here and with our trading partners. And an important trading partner is going in a different direction. That is, the Bank of Japan is going to be continuing a firm policy, even as the direction of travel for the Federal Reserve is to lower rates. I think they dismiss the movements of the dollar as mostly about that and view it more about the global investors' attitude of the safe haven status of the US dollar, which has been banged around a bit by geopolitical tensions, the trade tensions, the attitude of the administration toward some of our trading partners. So this is one case in which the chair automatically says the dollar isn't something we talk about, but he probably also believes is the dollar's got nothing to do with us right now. It's about a different landscape, and it's a geopolitical one.
Do you think that the series of rate cuts help weaken the dollar alongside other things that are going on, like tariffs and tensions, like you just mentioned geopolitically?
So nobody models the exchange value of the dollar well, but usually policy rate differentials go in the direction you kind of think that if you ease policy relative to your trading partners, it does tend to put some weakness in the dollar. That's not the big story now, though.
So, what about the US bond market? What about people's concern about fiscal dominance or financial stability? And if the dollar weakens and all these other things that could start shifting, for very least, we've already, I mean, 30-year bond went up, 10-year bond went up, right? They've kind of eased off. But I think a lot of people continue to wonder if and when and what's going to cause a move where people finally your debt isn't sustainable, something's going to happen, something's got to give, from your seat there at BNY Investments. Is that a concern of yours? What do you think the Fed should be on the lookout for? What do you think the bond market and bond market investors should be in line for?
Worrying about the sustainability of the U.S. fiscal position has been a family enterprise for a very long time. I
Yes.
got a bunch of papers about that, and many of them co-written with my wife,
Carmen
uh,
Reinhart.
Carmen Reinhart. So yes, we do worry about the fiscal position and it's not just a high level of debt relative to the GDP. It's the fact we have big deficits and the trend to non-interest expenditure relative to GDP is upward, and the trend of revenue to GDP is flat to downward. That puts a secular downward trend in getting worse and worse budget deficits. That's not sustainable. That's a problem. Why hasn't it come home to roost yet? The dollar's safe haven asset. We are the global reserve currency. There aren't many episodes in financial history of an economy losing that special status. It can run for a long time. And that's what puts off any day of reckoning. And the issue there to think about is when the dollar loses its safe haven asset status, then the fiscal position of the federal government is going to look particularly worrisome to investors. However, a deep law of economics is you can't beat something with nothing. And tell me what the other reserve currency that supplants the dollar
Mhm.
will be. And that's been to our advantage in the post-war period.
So, Vincent, let me pin you down a little bit. You and Carmen Reinhart, the two of you have written all kinds of things, as you said, about the risks of these. We call them unsustainably large deficits, but so far they seem to be sustainable in many ways. Um, do you have any, when you look beyond that, do you see any risk inside the banking system? Do you see a lot of people watching private credit and thinking private credit is where a lot of the funding has gone to from commercial banks, et cetera. When you look in that part of the equation, what do you see?
So a couple things. One is, yes, we worry about the long run sustainability of the dollar, but it hinges on something that doesn't change quickly, the dollar safe haven status. And since there isn't an alternative on the horizon, that suggests it's a climate risk, something that will happen at some point, but it's tough to position today accordingly. Anytime you have an expansion this long, after very big swings in the policy rate, you worry that somebody's out of position. You're going to learn something about somebody's balance sheet. You don't know what you'll learn. You don't know whose balance sheet it'll be. Uh, on my list of worries are first, let's go to treasuries, right? Uh, During the pandemic, after the great financial crisis into the pandemic, the Fed stayed very close to the zero lower bound for a long time. There was massive budget deficits and treasury issuance. Somebody bought that debt. That debt's been repriced, but maybe not on everybody's balance sheet. If you look at the
Mm.
FDIC data, The banking system still has about $500 billion worth of assets sitting in the held to maturity bucket, i.e., they haven't been repriced to the correction in longer term rates post-pandemic. There's a loss there. It will have to be absorbed. It could be absorbed over time, or it could put stress on some banks, probably regional banks. So we worry about that. Do we worry about private credit? Certainly. That anytime a market gets big, there are some stretching for yield, new entrants who may not fully appreciate the risks associated with those investments. Yeah, there's probably losses there. The U.S. financial system is essentially levered on real estate. The more reassuring news is we don't see major imbalances there. And so pockets of distress, yes. Can a well-performing, a high-achieving economy absorb them? Yeah, it could. And then if we're talking about excesses, the biggest one you have to worry about is the splurge in capital spending and capital valuations of firms associated with artificial intelligence. A lot of it is a familiar race to be number one in an industry, but not everybody can be number one. And so that it usually is associated with overinvestment. That usually is associated with circular reasoning, in which firms are reliant as for their customers on firms that are reliant on them as their
Yeah.
customers.
Hmm.
So that's a pocket of risk to overall economic activity for sure. Near-term trend relatively favorable. Uh, uh, we're in some sense asking the same question Alan Greenspan asked, are markets susceptible to irrational exuberance? Yeah, the answer is yes. But remember, Greenspan said that in 1996. It turned out to be right, but it was 4 years early.
Yeah. Well, I want to look at something else about today's meeting, and I'm glad we went over all that ground because it seems to me when people are looking at the dollar, looking at all kinds of things, it's one of those things that's a kind of a cloud behind you. But as you kind of pointing out, it's just not really hitting anybody yet. But that doesn't mean there is no risk there too. In looking, coming back to the Fed, and I guess now looking a little bit more about what's next. Jay Powell has two more meetings, so chances are, as some have said now, that no more. He's not going to oversee any changes. Is there any, there's no appetite for any kind of rate hike, right? I mean, what would you have to see? What would you say? Oh my gosh, I guess the economy is holding up well enough and inflation isn't coming down. Is there anything that would force the Fed to, or induce the Fed to go ahead and say, yeah, maybe we better do a rate hike?
Yeah, so let's first, make a distinction, and that is we're probably not going to see a change in the policy rate on Jay Powell's remaining tenure. It's not, however, on principle. He would be a happy camper to cut rates if he saw inflation fall. And he would be very assertive in cutting rates if the labor market faltered significantly. The
Okay.
fact is, we kind of think neither of that's going to happen, and he's in a wait and see mode because his committee's in a wait and see mode. He didn't go anywhere near the prospect of raising rates when he got that question at the press conference. That tells you his committee is leaning towards seeing the next move as cutting rates because they view the process as about renormalizing on the upside. If growth is somewhat stronger even than the buoyant forecast they got, if inflation's a little more stubborn, disappointingly so to them, they'll probably first say, well, at least the real federal funds rate is above our notions of neutral. We are putting some restraint in place. let's just keep it in place longer. So their first line of recourse, if they come to believe the economy is getting a little too hot, will be to say, let's just convey we're not cutting rates anytime soon, which in the world of shaping expectations and forward guidance is a form of tightening. So that's their first line of defense. They really have to see inflation disappoint and not just a one-off because of trade. They'd really have to see GDP grow well above trend and convince themselves it's not productivity. So I think they're
Okay.
asymmetric. They're leaning toward easing, but they're not going to do it anytime soon.
So, what do you make of the sense today from Chris Waller, a longtime board governor now, and Stephen Mirren, the newer board governor, but they didn't do 50 basis point. But
Yeah,
Mirren did each did
yeah.
25. And of course, a lot of people say, "Oh, I haven't said this for the longest time. I think Chris has very strong views about the economy weakening. He's been in this camp, leaning toward that for several months. Anyway, uh, what do you make of those? Should we just say
Well, yeah. Yeah, so look, I think we're in a world where we're going to see more dissents, by the way. We're in a world in which the chair's already retreated more to the sidelines and it's more talk from other policymakers. That's just where we're headed. With the sense at the latest FOMC meeting were a little bit surprising. Governor Moran's dissent was surprising because it was just 25 basis points, not 50
Mhm.
basis points. I think that just signals he is respectful of the institution and knows that 50 is outlandish and relative to his colleagues, and it just loses credibility. So he put a credible easing request in, and so it means he's learning on the job. Good for him. Uh, Governor Waller's dissent was somewhat surprising because previously, when he did it, he foamed the runway. He let us know in speeches or interviews that he was worried about it, that he wanted rates cut soon. We certainly know his inclination. He has been very forthright about rates should fall, but previously, when he felt strongly enough to be willing to dissent about that, he gave us a little warning. He didn't this time. I kind of think that's somewhat unfortunate, just because it just feeds conspiracy theories.
Conspiracy theory that he's wanting to get the
Yeah,
chairmanship nomination from
yeah.
from Jay Powell. Okay,
Yeah,
another
but
question.
he did something that he's been leaning into for a very long time, as you said. Unfortunately, he didn't give us warning about it.
Okay, in terms of you were 24 years at the Fed and
Yeah.
at a high level and dealing with so many aspects of how it operates, right? You're key person. So, of the people who are running or we know are being considered, who do you think would best fit into the current situation, be able to both calm the committee, become the Fed chair and get their respect, and actually try to satisfy the president at the same time?
So, Kathleen, I think you're asking me to grade my potential regulator before they're put in place, uh, which is which is not a place I'll go to. But here's something I will do. I'll do some math for you, right? So there have been
Okay.
10 FOMC, 10 chairs of the Federal Reserve Board since the position was established in 1935. All 10 of them had experience in the executive branch before they were tapped for nomination. 8 out of 10 were of the same political party as the president who appointed them. And the two exceptions were the first two, who were Republican businessmen when two Democratic presidents couldn't find anything else. But to, and what that tells you is it's a political appointment. They pick somebody who is familiar with the ways of Washington, who they are familiar with. But the other
Okay.
part is in terms of experience. Uh, Six of the 10 had some prior experience with the Federal Reserve. The last four actually being on the FOMC before asked to lead it. Five of them had some training in advanced training in economics, and five of them had experience in the private sector in business and finance. What do those numbers tell you? Nobody ticks all the boxes of what we expect from the job. There's always on the job training. And there's always
Okay.
on the job training for us because we're not sure what kind of chair they're going to be. Only one person ticked all the boxes before appointment, and that was Paul Volcker. And Paul Volcker was more chosen by financial markets for the White House at a time of distress. So, it's tough to, the slate of four nominees don't tick all the boxes in different ways. And whoever gets the job is going to have to learn on the job. And that's going to take some time.
How about building the respect of the rest of the committee? We could say maybe this person would be let more doubted by people who've been at the Fed a long time. Again, you've been there. Is that as someone just told me in the last couple interviews I did, that there's always deference, automatic deference. This will be the chair, but depending on who the person is and what they're experiencing is, will there be some that will have more difficulty winning that true respect and it's say for someone like Rick Reeder, wonderful guy, very smart. There's no reason the press likes him and is talking about him. It's not to put him down. It's just that he hasn't been at the Fed. There's a lot of things he's never done. And so I step back from Rick himself, but just broadly speaking, as someone who's been on the inside and watched these transitions happen, and not been someone who was like, Janet Yellen followed Ben Bernanke, but she'd been on the board of governors, she'd been the San Francisco Fed president. You know what I mean? There was this is more of a de novo person potentially.
So one thing I always say, Kathleen, is yes, I attended more than 100 FOMC meetings. I learned more about human interaction at the FOMC by watching John Hughes films about high school in the 1980s than attending those FOMC meetings. There are people who make monetary policy. There are people who come to the meeting with different status. They are people who are kind of needy about their status. And therefore, it does depend who comes in. Yes, they get a stamp that they were nominated by the president and confirmed by the Senate. That they get to put that on their wall. That puts them at the cool kids table, no question about it. But how much they get emulated, how much they're feared, how much they're respected, depends on the person. And everybody's going to come with preconceptions. And part of the White House is seen as being aggressive in the choice and putting litmus tests to the candidates might mean they come with more suspicion surrounding them by some of their existing colleagues. They're going to have to get over it. And the chair has soft power. It's not just that they were appointed by the president and confirmed by the Senate. They appear to testify for the institution. They make committee assignments. They can influence the board on budget. They can show up at your conference or not. Uh, if the chair can execute this, can use the soft power, then they can get the committee to move along with them, provided they make a convincing economic case. And so the most important thing for the next chair is to have a convincing economic case for the policy choice.
Well, you put it all together. I love the John Hughes movie analogy and so much more. Vince, thank you so very much. And of course, you're in the phone book. If they need some help on the good economic policy, they can always give you a call quietly.
I'm on the web too.
There you go. Vincent Reinhart, thank you so very much joining me here on Central Bank Central right after the Fed meeting. I want to remind everybody that Vince Reinhart, Chief Economist at BNY Investments, and I just want to remind 24 years of the Federal Reserve, very important positions, head of the Director of Division of Monetary Affairs, Secretary and Economist of the Federal Open Market Committee. Thank you so much for taking the time.
Thank you, Kathleen.
I'm Kathleen Hayes, and this is Central Bank Central.